Today, household financial confidence slides again. Hi again, it's Martin North from Digital Finance Analytics. Welcome to our latest posts covering finance and prop news with a distinctively Australian flavour. We continue to release the data from our household surveys to the end of November 2019. So today, we look at our Household Financial Confidence Index, which examines how households are feeling about their financial status relative to a year ago. The index dropped again to 83.5. which is a new low in the series and well below the previous 87.69, which was back in 2015. And this level of concern suggests households will keep their wallets firmly in their pockets, so expect more retail weakness and household consumption easing lower ahead. The one bright spot was that more households are now believing their net worth is higher, thanks to the perceived recovery in home prices and recent stock market highs, though offset by lower returns on deposits, flat incomes in real terms, and rising costs. And recent tax cuts and refunds don't seem to have touched the sides. The decline in confidence are broad-based, and those mortgage-free still below neutral, while those with a mortgage are still more negative, and those in the rental sector without property even lower than that. So turning to our segmentation by property type, the news about rising home prices has impacted property investors despite the continued weakness in rental income. Thus, we see a rise from very low levels for this cohort from 77.01 to 78.45 in the month. On the other hand, property-active owner-occupied households were a little less positive, moving from 97.1 to 97.05, while property-inactive households also drifted lower. Now, across the states, there was a significant decline in New South Wales, from 88.4 to 86.2. And this is connected with rising household budget pressures and large mortgages in Sydney, plus the fires and drought across the state. Victoria fell a little too, while there was a small rise in Western Australia. Across the age bands, those aged 20 to 30 years reported the largest fall, thanks to pressures on income and rising costs. A number of new first-time buyers who bought in recent months reside here. On the other hand, older cohorts are a little more positive this month, thanks to recent stock market rises and some better home price news. We note, for example, the headline of 6% plus rises in prices across Sydney have been interpreted by households in all postcodes as appropriate to them, which shows the impact of a tricky headline, remembering that price rises are much higher in the more affluent upmarket postcodes. Turning to the moving parts within the index, job security remains under pressure, thanks to underemployment, part-time jobs, and the gig economy. And there's also weakness in retail and construction, and of course the upcoming holidays too. 7.8% felt more secure than a year ago, down from 8.23% last month, and 38.65% said they were less secure compared with the 38.12% last month. Incomes remain under pressure, with just 4.3% saying in real terms their incomes were higher than a year back, and that's down from 5.3% last month. Pressure on household budgets is a pincer movement as incomes are compressed and returns from some investments and deposits fall, but costs of living are rising. In fact, 94.2% reported higher costs than a year back, thanks to higher prices for fuel, electricity, school fees, childcare, and everyday needs. Only 1.3% said their cost of living had fallen over the last 12 months. Debt remains a major issue for many households, despite the rate cuts. Some households are paying down their mortgage faster than required and are using the lower rates and tax refunds for this. In an era of uncertainty, this is not a surprise. We also see a rise of households under pressure turning to payment options like Afterpay to support their purchases. Just 2% of households were more comfortable with the debt levels they had than a year ago, while 48% were less comfortable. Some households have been building their savings, using lower mortgage rates and tax refunds to build resilience for later. However, lower interest rates on deposits are creating their own pressures, while those with stocks and shares are seeing some dividend pressures too, and around 20% of households have insufficient funds to cover a month without work. Just 0.42% of households were more comfortable than a year ago, while 49% were less comfortable and 45% about the same. And finally, looking at net worth, which is defined as assets less liabilities, they have reacted to higher reported home prices. So 27% say their net worth was better than a year ago, which is up from 24% last month, while 43% were lower and 24.65% about the same. Net worth is also boosted by high stock market prices and exchange rate movements. So, in conclusion, the household sector remains under pressure, and as a result, financial confidence is bruised beyond immediate repair. That is, until such time as wages growth really starts to accelerate in real terms. And in addition, the broader discussions about lower cash rates and quantitative easing are also helping to degrade confidence. The only bright spot, real or illusory, is the recovery in home prices, which of course are not uniform across the main centres and postcodes, and on this front, households are hoping for the best. We'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again